Of.
This is Taking Stock on Bloomberg. I'm Pim Fox. Now, the head of the Congressional Joint Economic Committee this week said commercial real estate is a ticking time bomb. With the default rates rising for hotels, malls, and other properties, few in the industry would disagree. Let's bring in an industry expert. Brent Davis is a partner with Alliance Commercial Partners based in Lakewood, Colorado. Good to have you with us, Brent. Thanks for coming by. I appreciate your schedule. How bad, okay, ticking time bomb, or is it the time bomb already gone off? How bad is it?
Well, it's a growing problem, no doubt about that. You have two issues. You have an erosion in value that with the spike in cap rates from last fall, combined with eroding fundamentals very quickly. Spike in cap rates, rental rates declining rapidly, credit defaults. So it's a growing problem, and there's bank illiquidity in which people cannot refinance their mortgages, commercial mortgages, or even buy new assets.
All right, let's talk about the relationship of the banks in the commercial real estate market right now. Let's say you're in the commercial real estate business, you're not getting the rent to meet the note. What's the bank saying to you right now?
Well, right now, a lot of banks are kicking the can down the road. And they're rather, instead of addressing the issue today, if they're getting their interest payment, they'll turn a blind eye and wait for the maturity to hit. And then there could be a modest pay down or just an extension of the maturity date.
But if they do that, what's that do to the value of the actual property?
Well, values, from our perspective, have declined 30 to 50% from peak pricing, and that's on gross. So if someone had mortgaged the property by 70%, and if you believe our statistic, that mortgage is underwater today.
So how do you do new deals with that kind of metrics for the business that already exists on the ground? Can you do any new deals?
No, and that's the problem. Real estate is a transaction business, has been over the last 10 years, but there are very few transactions, partly because people cannot afford to sell. Buyers won't pay the price people are looking for to sell their properties, and the banks won't take the hit today.
Sounds like there's a gap some here. Then who's going to fall into the gap? Who blinks first, do you think?
Well, right now the pressure's not on the system by the federal government to recognize by the banks what they have. And until that happens, the banks are going to continue to kick the can down the road. There's $1.8 trillion of bank debt secured by commercial real estate. Of that, 25% is expected to go into default. And that is a very large proportion. Of that amount, only about 10% has been written down.
Only 10% has been written down of that 25%
Yes.
of the total 1.4 trillion?
Yes.
That sounds like a big number.
It is a big number. And cap rate, there again, you've got two issues. First, you have the valuation issue. Cap rates have spiked 200 to 400 basis points in the past 9 months. In addition, you've got eroding fundamentals, eroding NOI to service the debt. Those two factors are just a double whammy.
I should have pushed you earlier, but for those who are not experts in the world of commercial real estate, cap rates, just give us a primer. What's a cap rate and why is it important?
It's like a reverse PE multiple. It's a simple NOI figure divided by purchase price or value.
And that's not working in anybody's favor right now.
Not today.
What about some of the geographical markets that we're all familiar with? I mean, you're based out in Colorado. What about let's say, Arizona, the Phoenix, Tucson markets? What are they like?
Well, the markets that we cover have different levels of stress, and that's SoCal, Phoenix, Denver, and Chicago. Those are where we have investments, so we know those markets well. Florida a little bit. Phoenix is very, very difficult. It is probably one of the worst markets that we're in. You have vacancies that have increased to 25% and probably going to 30% on office. Industrial's not far behind. Residential has not found a floor. And employment growth is still unemployment is still growing. SoCal is actually doing better, believe it or not, even though that's very trade-oriented on the industrial side. Vacancies are below 10% generally for the infill markets, and 5% sometimes. Rental rates have adjusted down, but there's still tight occupancies there. Office is actually held up well, too, depending upon the submarket. The frontier stuff is having a very tough time, but downtown LA is doing well, West Side's doing well. So it's spotty. Denver's actually holding up reasonably well. That doesn't say they don't have problems. They do, because the valuation issue is going to be the big driver as loans mature.
All right, and that's something that we just don't know what's going to happen, although that can seems to get kicked further and further down the road.
It has to.
All right, I want to thank you very much, Brent Davis, coming in from Alliance Commercial Partners. Thanks for sharing your insight and expertise in the world of commercial real estate. Appreciate it.
Thank you.
A lot.